You make good money, more than your parents ever did, more than most people in your zip code. And yet at the end of every month, the number barely moves. That is not a coincidence. That is a system doing exactly what it was designed to do. Most high earners never figure out why. You are about to. If you clicked this, you already suspect something is off. Not with your effort, not with your ambition. With the rules nobody handed you when the income went up. In this video, I am going to show you 10 specific reasons high earners still end up broke. Not because they spend too much on coffee, because the system scales with you, because the traps get more expensive as the paycheck grows. And by the time we reach number 10, the way you see, income will never be the same again. Here is the number most people do not want to look at. According to multiple studies, nearly 60% of Americans earning six figures live paycheck to paycheck. Not broke by appearance, broke by reality. The car is nice, the house is big, the account is empty. This is not a character flaw. It is a pattern. And patterns have causes. Here is exactly what is happening inside that pattern, and how to stop letting it work against you. Number 1. Lifestyle inflation. Every raise triggers a spending upgrade, new income, new car payment, new apartment, new wardrobe. The math never catches up because the spending moves first. Picture two people getting the same promotion. One keeps their lifestyle and invests the difference. The other upgrades everything and saves what is left. 10 years later, they are in completely different financial worlds. The first person has built something. The second has nothing to show. Nothing except the lifestyle everyone around them assumes. Means they are doing well. Income went up, wealth did not. Number 2. The upgrade reflex. High earners feel entitled to match their spending to their status. This is the most expensive feeling in personal finance. The belief that a bigger paycheck earns you a bigger lifestyle is not ambition. It is the trap wearing ambition's face. The $300 dinner, the business class upgrade, the apartment that is $500 more but feels like you deserve it. Each one feels like a reward. Together, they become a ceiling. And the ceiling is invisible until you stop climbing and look around. By then, the lifestyle has locked in. The spending has become the standard. You are not spending on wants. You are spending on identity. Number 3. The tax bracket blind spot. Most people dramatically overestimate what they actually take home. A $100,000 salary does not feel like that. After federal tax, state tax, Social Security, and Medicare. In many states, you take home closer to $65,000. Yet people budget as if they earn the full amount. Picture a family building a spending plan on gross income. Every month, they wonder why the math does not add up. The paycheck is real. The number in their head is not. Spending starts at the wrong number and compounds from there. Build every budget on what actually lands in your account, not the number on your offer letter, the number in your bank. Here is where it gets uncomfortable. Number 4. The debt normalization tax. At higher incomes, debt does not feel like debt. It feels like leverage, like sophistication, like what smart people do. Car loans at low rates, home equity lines, premium credit cards. The language around debt gets more polished as income rises, but the mechanism is the same. You owe money you have not earned yet, and while you are making those payments, you are not building anything. Debt does not become strategy just because the income is higher. The payment is still a hole in the floor. Number 5. The invisible subscription layer. High earners have more subscriptions than they can name. Streaming services, software tools, memberships, premium apps. Each one is $12. Each one is $24. Together, they form an invisible layer that drains $300 to $500 every single month from accounts that do not track it. Most people have not looked at their full subscription list. In over a year, do this exercise. Write down every recurring charge on your account. Most people are surprised by at least 4 items they forgot exist. Small numbers with automatic renewal are the quietest thieves in your budget. Number 6. The zero balance spending signal. High earners often spend based on account balance, not a plan. There is 5,000 in checking. That feels fine. Spend freely. But fine is not a number. It is a feeling. And feelings are not a financial system. Without an intentional spending plan, more income creates more financial noise, not more financial clarity. 2 people, same salary, same city. One budgets every dollar before the month starts. One checks the balance and decides based on what they see. 1 year later, one of them has a 3-month emergency fund. The other cannot explain where it went. Money without direction does not accumulate. It disappears. Number 7. The wealth performance trap. Here is the part nobody talks about. High earners are often more concerned with appearing wealthy than becoming wealthy. The watch, the car, the neighborhood. These are not just purchases. They are signals sent to other people. But the people you are sending the signals to cannot help you retire. According to research by Thomas Stanley, most millionaires drive average cars and live in ordinary neighborhoods. The people who look the wealthiest are often the furthest from it. Appearance is expensive. Wealth is quiet. What we are covering right now goes deeper than most people ever discover on their own. The strategies, the systems, the actual numbers behind building real wealth on any income level go further inside the Luxona vault. Link is below if you want in. Now let us keep going. Drop in the comments which one of these has hit closest to home. Number 8. The emergency fund gap. High earners feel like they do not need an emergency fund. The income feels like the safety net. But income is not an asset. It is a flow. When that flow stops, a high-income earner without reserves is in more danger than a modest earner with 3 months saved, because the expenses scaled up with the income. The mortgage is bigger. The car payments are bigger. The burn rate is bigger. A job loss at $150,000 per year with no reserves is a financial emergency in 60 days. Most people at that income level have never seriously modeled that scenario. They assume the income continues because it always has. Income is not protection. Cash reserves are protection. Number 9. The investment avoidance paradox. Here is one of the most counterintuitive truths in personal finance. High earners often invest less than they should because they always plan to invest more later. The raise is coming. The bonus is almost here. I will get serious after this next project. Later is the most expensive word in wealth building. $400 per month invested consistently. Over 30 years at a 7% return. Becomes over $450,000. Most high earners have the $400. They just keep spending it first and planning to invest the rest. There is no rest. There is never a rest. Number 10. The retirement delay illusion. High earners routinely underfund retirement because the income makes the future feel manageable. I will catch up when I earn more. I will max out contributions after we pay off the car. But compound interest does not wait for convenient timing. A 30-year-old who invests aggressively for 10 years and then stops will often outperform someone who starts at 40 and invests aggressively for 25 years. The first decade of investing is the most valuable decade. High earners often miss it because they were busy earning. Most people will read that last sentence and feel something because they already know it applies to them, and this is where the system becomes visible. But here is what none of this is really about. The subscriptions are real. The inflation is real. The tax blind spot is real, but the deeper pattern underneath all of it is something else entirely. It is the belief that income and wealth are the same thing. They are not. Income is what you earn. Wealth is what you keep and grow. Every system described in this video works because high earners are not taught to separate those two ideas. Nobody sits down with a rising earner and says, your behavior has to evolve faster than your paycheck. Nobody explains that the lifestyle traps scale with income. Nobody teaches that the debt gets marketed differently at higher levels, but the mechanism is identical. The result is a generation of high earners who look successful on paper and feel confused every month. The confusion is not a personal failure. It is the natural result of chasing income without a system for wealth. This is the part the financial industry does not want you to see. Wealth is not built by earning more. It is built by understanding the difference between earning and keeping. Every high earner you have ever envied either learned this early or paid an expensive price for learning it late. You are watching this. That puts you ahead of most people at your income level who have never asked the question. The path forward is not complicated. Spend less than you earn. Avoid debt. Invest consistently. Not exciting, not sophisticated, but proven by millions of people who built wealth on average salaries with disciplined behavior. The next video takes this further, because once you stop letting income drive spending, you start to see what wealth actually looks like from the inside. It is quiet. It is intentional. It is built one decision at a time. Welcome to Luxona, where millionaires are made.